Hey, before we get started, I want to talk to you a little bit about our theme for this quarter, growing and protecting your portfolio. We're excited about various topics centered around this, but it really comes down to three concepts that will help you grow and protect your portfolio. You can find a PDF on our website about this. Go to wiserinvestor.com, scroll down to the bottom, enter your email address, and you'll get the PDF titled 3 Ways to Grow and Protect Your Portfolio. Thanks for listening. Welcome to a Wiser Retirement Podcast. We cover financial topics such as retirement planning, tax planning, portfolio management, insurance, and estate planning so you too can have a wiser retirement. I'm your host, Casey Smith, guiding you to financial freedom. Today is my co-host, Brad Lyons.
Hi,
hey,
Casey.
Brad.
How are you?
Doing good.
Good.
So this podcast today is just kind of a wrap-up. We've had a great quarter talking about or focusing on 3 ways to grow and protect your portfolio. And you know, it seems simple, but human nature kind of counteracts that. And I think we have some perfect examples of just what's happened in the first quarter of 2022.
Yeah, we tend to be our own worst enemies sometimes when it comes to investing for the long term. I think when you talk to people in a reasonable manner, they all say and agree that we should invest for the long term. Money should be put away for a long time. And yet when short-term events occur, our emotions have a tendency to take over and contradict what we just think in a reasonable manner. And we want to trade into that volatility sometimes in order to protect ourselves. But in reality, what we're doing is we're not protecting ourselves. We are damaging our portfolios, trading into short-term volatility.
You know, we follow a lot of different companies and their economic departments, analysts and such. Chances of war in 2022 was like less than 10%.
Yeah, when you look back at predictions for 2022 by these larger companies that try and foresee what's going to happen in the markets and make their long-term capital market assumptions given what they know currently at that time, and there weren't any that were saying that war on the world geographic front was going to occur.
Yeah, I mean, and then there's more risk out there because the same people are also saying it won't escalate past Ukraine, and they don't know that.
No, we really don't know what's going to happen in the end. But we do know that by maintaining a long-term focus, we keep going back to this, but maintaining a long-term focus, that these things are built into capital market assumptions. We know that events are going to occur geopolitically. We can't predict them. We can't name them ahead of time, but we know that they occur over periods of time. And the portfolios that we build are designed to absorb these shocks from time to time that occur.
Yeah, that goes back to the planning. When you look at when you're doing your retirement planning or financial planning, you have to build in to the scenario drops in the market and the catalyst for those drops, like 20% drops, followed by another 10%, followed by no recovery and just a 5% rate of return going forward. That's a model that you have to be running on your portfolios and your cash flow to see, can I still stay retired in that environment? And all of our clients here, we do that. I focus on it more than they probably realize. To the downside of investing, and can we keep going? But it's hard to do that when there's so much chaos that you want to run for the hills. And I mean, geez, if you'd gone to cash, you would have lost 7 or I guess 8.5% now over the last 12 months. That's not good either.
Right.
So the bottom line is when in times like this, you bet on American large cap, and we've always been overweighted American large cap anyway. But that's how you get through inflation. That's how you get through times of crisis. Is the Fortune 500 companies here in the U.S.
Well, in a broad sense,
a good place to stay. A good place to be.
They have the financial resources to weather short-term shocks in the markets. In their markets, in their business and their industry. They have the financial wherewithal to weather this. And they also have the purchasing and pricing power on both ends of the spectrum in order to accommodate the different circumstances that exist when they're buying their goods and services in order to produce them, or when they're selling it into the marketplace as well. So, yeah, large cap tend to do well in times of volatile and times of geopolitical and economic shocks. So, being overweight that, we feel confident that the S&P 500, for example, will be fine in the end. And when you look at these charts in arrears, and we look at study charts, you see that these things are simply blips on the chart, and you can barely point them out. Years come. But when we're in the midst of it, and when clients are in the midst of it, and asset owners are trying to figure out how to navigate, these circumstances, the news that comes at them is so difficult to filter out the difference between what is truly an economic circumstance that is changing, that may change the fundamentals, and what is simply news and noise that fills time on those hour newscasts.
No, absolutely. And I want to get to what we're going to do next quarter. I'm excited about next quarter, but before we kind of roll into that, let's talk a little bit about, we talked about keeping costs low, maintaining a diversified portfolio, and focus long term. It's been kind of a mantra here since the beginning of my company in 2001, and then we merged in Wiser in 2007. We adopted that for all those clients as well. You think about diversification as being so important, but then you look at the world right now, and me, when I see it, when I look at the portfolio, I go, man, why do we have emerging markets in portfolios? We're literally watching a country being eliminated economically from the world, being Russia.
Right.
And it's a very small percentage of the portfolio anyway, under 1%.
Oh, well under 1%. It's a very small percent of the index.
Yes.
It's like less than 3% of an entire emerging markets index. So,
which is crazy to me that, these guys are just bullies. They have no economic power in the world whatsoever, yet they have the most nukes.
Yeah.
I'm like, who's in charge of the shop here? It seems to me we should have been negotiating some of this since 1991. But
what has happened in the index is that Russia has been removed. They've effectively written down any investment in Russia that they were unable to sell as an index and to report on. They've written it down to zero. So they've been effectively removed from all the indexes.
But then you have specific ETFs that track only Russia.
Yes,
and that's not a good investment right now.
No, it was debatable whether it was ever a good investment.
Well, that's true. That's true. Yeah, and then you have all the you think about all the industries that we're trying to develop in that country that no longer have access to their assets and probably never will.
Right.
At least for a very long time.
Right. But anyway, why diversify into a marketplace that's emerging? Just by definition, why do that? And that's because when they grow, they tend to grow at very fast rates. Okay, and they are developing. They will develop into developed markets over time, and they do have products and services that are used and exported throughout the world. Ukraine, for example, is one of the largest exporters of wheat. Okay, so it was, so we, as an investor, you have an opportunity on a world stage to profit from that. And that's what you do when you diversify into these different markets, is you're looking to profit from what they have to offer. Now, traditionally, emerging markets have natural resources as one of their greatest economic engines. Okay.
Brazil.
Well, years ago, America was, an agricultural society, and we exported, a lot of agricultural products, and we developed from there.
Right.
Okay. And many of these other countries will too. A lot of these countries are developing in technology, okay? As programmers and software consultants move past the baton from around the clock, around the globe, in order to take advantage of the 24 hours that exist, in the world and different time zones. And so they're simply passing the baton and the workflow and the tasks from one country to another. And emerging markets are taking advantage of that and living in that environment. So,
to shift gears a little bit, I feel like there maybe should have been a fourth way to grow and protect your portfolio, and that's turn off a lot of financial social media from so-called experts.
Yeah.
It's amazing what I've been sent from different people. There's some guy out there right now claiming that because Visa has pulled out of Russia, along with a lot of other, financial systems, the whole basis was that, well, they'll no longer be transacting in dollars, and that they're going to, it's going to crash the whole dollar. And first of all, if you're in Russia and you're using a Visa credit card, it's not clearing in the U.S., it's clearing over there in their local currency. So, yeah, it's going to hurt transaction fees and be less revenue for a company. But the fact that it would crash the U.S. dollar has no basis whatsoever. It just doesn't even understand. But you could buy his newsletter. I did a little more digging on it. I was like, you could buy the newsletter, and fear sells, right? So there's a lot of false information going around out there that Russia is going to start using a Chinese credit card type system, and that's fine. Let them go do that. But that does have anything to do with the stability of the U.S. dollar.
Right. Sensationalism sells, and it's always sold, and it will always sell. They're taking advantage of that, given a new platform that is unfiltered in social media.
Right.
Right? So,
well, somewhat filtered, depending on how you look at it.
Yeah, like mine is just completely off.
Yours is completely off. Mine's definitely not filtered. But if I posted anything about COVID or President Trump, it would quickly be filtered. Or to have that little thing that pops up on.
You'll know you have arrived.
Well, you can arrive pretty quick. You just have to type the right things. Yeah. Or the wrong things, depending how you look at it. These are tough times. I think we've been so used, all first world problems, but we've been so used to a 10-year track history of almost straight up. We're still up over 200% for 10 years.
Yeah.
So people are starting to see, oh my gosh, the portfolio keeps falling. Where before we get these quick drops and quick rebounds.
Right. In many ways, when you look back now that we have some perspective on the COVID event and the market event that occurred, at the beginning of that, it was so dramatic. It was so steep. The comeback was so dramatic and so steep that it almost was such a blip that we forget that it even occurred. Because at the time, Casey, we were distracted.
Right.
Society was distracted by this thing over here called COVID.
We're all trying to not die.
And you could die from it,
Right.
So yes, we knew our portfolios were going down. We knew that this was occurring, but we were distracted in some way. Now that we have no distraction whatsoever, I mean, it's full frontal, news story every day.
Right.
You've got inflation. You've got Russia invading Ukraine. You've got interest rates about to rise, and what's the effect that that's going to be after 8 years of not rising, something like that. So as you can see, there's some things out there that are distracting, or full frontal, news that are distracting us from the focus of maintaining long-term approach in a portfolio designed to meet the goals and objectives of any asset owner and investor through a financial planning process.
You have to remember too that even when price falls, dividends stay the same. In some cases, dividends actually go up if they start doing buybacks.
So new money
for new money. Yeah. So you're still getting income, and over the long time period, typically income is a very large percentage of your total return. There's some ETFs that's their whole premise of existence is
and they've
dividends.
Done the research and shown that somewhere around 40% of the S&P's total return comes from dividends and dividend reinvestment. So yeah, 40%.
Which is why you stay invested. If you go to cash, you're not getting into any of that income.
That's right. You're not getting that lower dividend reinvestment rate when there are dips in the market.
There's a company, we have an online robo-advisor called FlightPath, but it's built off the Betterment platform. And Betterment does a really good job, almost annoyingly a good job. If they send out almost like weekly emails saying, you've got X amount of dollars in income this week. And I feel like that's something that advisory firms to start embracing a little bit to get people to focus on income being produced and less on price return. Because, 7 out of 10 years, you're probably going to be making money on the price side. But if you focus more on the income, those 3 years that the market's down, it might allow people to stay invested longer when they realize that they're getting a check every month. They didn't even focus on that before.
Right.
So they're probably onto something. Behavioral finance is a funny thing, but that would be that'd be harder for some firms to do. I don't know if they even calculate it, honestly, what the yield is or what the income is on a portfolio. Mm-hmm. So, all right, well, keep costs low, maintain diversification, and then focus long term. Basically, find your optimal portfolio, and for the most part, leave it there. Although we've made some changes recently.
Well, we do, but that's part of professional portfolio management, is adapting and adopting to new news and new market fundamentals. And we don't make changes based upon the news,
right?
But rather when the fundamentals of the market have changed and require an adaptation to that change. Because by definition, the stock market is always changing. The bond market is always changing. The environment is always changing. Okay, and until it changes in such a way that the fundamentals are completely changed in the way that requires a manager to make adoption to that change and adapt to that change, it should stay the same. Okay, and that's what we did. And so when inflation was recognized as not being transitory anymore, we bought Treasury inflation protection securities and put those in the portfolio. So when a fundamental change occurred, such as the removal of the word transitory, we made a change and adapted our portfolios to that.
Yeah, and we might have a few more tricks up our sleeve. We're doing some research on float.
Right, floating rate securities that rise, the coupon rate rises as interest rates rise, thereby protecting the principal value of the underlying note. So,
I think that's important to note here that we're more focused on protecting the bonds right now and not as worried about stock, because typically if you want to beat all this that's happening in the world right now, you're going to beat it with U.S. large cap. So that's we're not tinkering with our stock portfolio, which is the most volatile. We're focused on what I think, and you do too, is most at risk, which is your fixed income.
Right, because of these three things that we mentioned.
Yep.
Inflation, rising interest rates, and the invasion of Ukraine, muddling the ability to sift through that and focus on inflation and the interest rate, environment. So,
okay.
Yeah.
Well, I'm sure we'll have more podcasts about that here in the future. So, Brad, I have been to 2 rocket launches in my lifetime, and I've done them all in like the last 6 months. And I've always been interested in space and space travel, and my favorite movie is Apollo 13. I feel like most of my life has been, that scene where they have everything on the table and they go, "Gentlemen, this is
I recall that movie. I know exactly what you're describing, Casey.
This is all we have to get home."
And it's just this amalgamation of weird things.
Yes.
There's a tube, there's a box, there's a pencil.
And leave it to the government
and of course, duct tape.
Duct tape, yes. And leave it to the government to develop 2 different modules that have 2 different filtration systems and they don't match, right? And so that's where the duct tape comes in
things together somehow
to get these guys home. And if you haven't been down to the Kennedy Space Center, they're not paying us for an advertisement, by the way. They're welcome to, but they're not paying us for an advertisement. What a great experience! I've gone down with my youngest son and my dad twice, and and some friends, and it's been a great experience. Especially the second time, because the Astronaut Hall of Fame, I decided to tour that last, and actually when I went in there, I was like, "This is really neat. This is really neat." I had these glass plates up on the wall with all the astronauts that were in the Hall of Fame and how many missions they'd gone on. And it was it was very telling. Modern astronauts, there was a guy there who had like 10.
Yeah.
And then he's like, the first astronaut's like 1, 2, because of all the effort just to do that 1 or 2, right? it's I say all this because you're sitting there. The first time we were 10 miles away. The second time we're about 4 miles away, and they're this countdown. They're going to launch these guys into space. Both times we went to NASA, SpaceX, NASA launches, joint venture to get the astronauts to the International Space Station. And you sit there and you think, what are those guys thinking when they're sitting there on that rocket? And you're waiting, like the anticipation. They've been training thousands of hours for this, right? But there's still some anxiety, especially for the first timers. Now they have cameras on the inside now. You actually see them, and they just kind of seem to, just kind of hanging out like it's no big deal. But in their brain, they got to be.
They have to be.
You would think. Yeah. And so I say all this to say, one, go see a space launch. That's pretty cool. And then go check out the museum. But two, I feel like that's how people are as they approach retirement. They've been saving, and they're like, is this going to work? Can we do this?
Right.
Can we,
Yeah. And similar to the launch, what's that first step going to be like into retirement?
That's right.
Is it a step off a cliff?
Yeah.
Or is it just one more step out the door that morning, like any other day to pick up the newspaper on the front stoop?
Right.
What's it going to be like? You only get to do it once. It's like the guys who've trained for the 1,000 of hours and the women who have trained for 1,000 of hours to be astronauts. And then that first trip,
right.
That they go into space.
Well, the thing about the astronauts and the whole program, the whole mission is they do the launch, but then you're in orbit. You got to survive, right? And so many people, when they do retirement planning themselves, they just try to figure out, can I retire? And a lot of times the answer is yes. Yeah, I have enough money here to replicate my income. Can you stay retired 20 years from now? Or are you going to end up being one of those people living off nothing but Social Security, right? Mm-hmm. That's the hard part, is you have to maintain the retirement orbit. And so we've developed a checklist, and we got really creative with this. We have a great team here. Hadley put together did a great job putting this piece together. So it'll be available for download soon. And it's a checklist. It's kind of like your pre-launch checklist. Just like astronauts run through a checklist, this is your pre-retirement checklist. And we started off at 5, and we count backwards, right? Because that's how they launch a rocket, right? As opposed to, here's 5 things you need. So I thought we would do it T-5, right? 4, 3, 2, 1. Anyway,
very nice.
I'm a big dork, and I'm dork alert all the way here. But
it's a great analogy. It really
is. It is. So you can't. When you get ready for retirement, there's a lot of things that you're going to have to focus on initially, which is the hard part. The hardest part is just getting the rocket fuel in. That's do I have enough money to be able to accomplish this? And what's interesting is everyone's different. Some people have pensions. Some people have bigger Social Security. Some people built and grew businesses don't have much in Social Security, but they sold a business for a lot of money. And so they have to think differently about how they stay in orbit.
Right.
Right. So, ultimately, I think these are 5 things that everyone needs to have answers to before they go about their retirement journey. And we're excited to start a whole new quarter centered around these. And soon, when we launch our next podcast.
Oh, I heard that where we launch it.
Yes, exactly.
Well done.
Yeah, it's going to be a crazy quarter. Rocket analogy the entire month or entire 3 months. But yeah, when we launch our next podcast, we're going to then make the download available for all of our listeners.
Well, I look forward to it. It's going to be a good quarter.
It is. Mm-hmm. It is. All right, Brad. I guess we better go start planning this podcast, and we don't want to disappoint all of our listeners. But we'll see you on the other side.
Sounds great.
Thanks for listening to a Wiser Retirement podcast. We hope you enjoyed today's episode. Make sure to subscribe wherever you're listening, that way you don't miss any new episodes. We would also appreciate if you could leave a rating and review. If you have any questions about anything that was discussed today, head to wiserinvestor.com and reach out. We would love to hear from you. This episode was produced and edited by Lilton Moore.